So by now you've probably seen our video series on cash secured puts and covered calls. If you haven't, now's a great time to go back and review those to make sure you have a solid understanding about how they work. Individually, they're both great strategies that help you capitalize off of the value of selling options. But in this next video series, we're going to talk about how to use them together in what I consider to be the single best value investing strategy available. We call it the HT wheel, which is a variation of the popular triple income strategy. So how does it work? Let's dive into it. This is the Hourglass Trader, where as time passes, we make money. So for a quick recap, we remember that there are two options when we sell cash secured puts. We can either hit max profit, in which case that's exactly what we were looking for and we sell puts again the following week, or we can be assigned shares if the stock falls below the strike price of our puts. Looking at the AMD example, the shares were trading just under $77, so we sold a $75 put for a $2 premium. Following the calculation set out here, we effectively only paid $7,300 for these shares thanks to the $200 premium that we received. So our basis in the shares is actually $73, which represents a 4.55% discount from what was the current price. So that's great and all, but the question is now what? We scored some shares at a steep discount, but what's the next step? Do we just sit on the shares until they become profitable? Do we sell more cash secured puts? The answer is that we take the shares that we've been assigned and use them to sell covered calls. So you essentially move from the cash secured put strategy into the covered call strategy once you've been assigned shares, and that's a high level overview of how the wheel works. There are still some intricacies that we need to review, so don't quite close the video yet if you think you've just had an aha moment and completely understand it. To best explain the basic process, we'll take a look at a couple real trades that we made. Alright, so let's take a look at a trade that we did with Tilray, the cannabis company, ticker TLRY. So on August 5th right here, 2020, when we opened the trade, Tilray was trading at $8.42. So what we did was we opened an 8-strike put. We opened 100 of them that expired on August the 7th. So pretty much 2 days after that for a 32-cent credit. So we know that if Tilray finishes above 8, that we would make max profit on here, which if this were a 0 debit to close, that would be $3,200. And that's a pretty solid 2-3 day profit off an investment like this, which is why selling cash secured puts is something that we think is a really attractive investment option. But if we hit max profit, probably we wouldn't be talking about this trade as an example for this video. So let's go ahead and take a look at what happened. So right off the bat, things went south pretty quickly for this one, and it dropped all the way down to $7.50 by the end of the week. So we're going to drop this right here to $7.50, and that's a 10% decrease on the price of the stocks. That's a pretty steep drop for just 2 days. So since that dropped down to $7.50, that meant that at the end of the week on August 7th, our 8-strike puts were in the money, so we were going to be assigned these shares. So let's put this back here to a 0 profit or loss. All right, so we were assigned these shares at an $8 strike price, which means we had a $5,000 loss right off the bat on these shares. But we do remember that no matter what, we keep the premium. So that was at least netted against the $3,200 premium that we received for a total loss of $1,800 right here. And let's try to keep track of our basis as we do this. So we know that our basis is going to be the strike price of 8 minus the premium of 32 cents that we received. So while we started playing this $8.42, it's dropped all the way down to $7.50. We're really not too far into loss territory because we're only 18 cents above the current price with our basis. So what does that mean for the next step of the wheel? We have these cash secured puts that we sold. We got a sign on them. We have 10,000 shares of Tilray. So what do we do now? We're going to move into covered calls. So the call that we chose for 8/14 the following week is going to be the 8-strike call. We chose this because we know that if our shares get called away at 8, we'll have made profit because our basis is below 8. Normally when you run the wheel like this, you're going to want to sell covered calls that are above your basis because that guarantees a profit if those shares get called away. So what would that look like if those shares get called away? Well, we would get this no matter what, and if the price went up to $8, we'd have a pretty big profit right there, since we would have essentially a break even on the shares. They were assigned at 8, we got them called away at 8, and we would just collect all the premium in between, which would be a $7,200 profit. But as you could probably guess with the theme of this example that we're going through, that was not the case, and Tilray dipped a little bit further for us. So let's go back to 7.5. What actually happened was it dipped down into the 690 area, and it was a pretty steep dip, so we were sitting at about a $3,800 loss at this point. But this was pretty early on in the week. This was about Monday or Tuesday, and we realized that we looked at our 8-strike call. Since it dropped so much further, the value of these cratered, and they got all the way down to 8 cents. At that point, we decided, okay, let's close these out and lock in that $3,200 profit. And since there's still 3 or 4 days left in the week, let's sell more covered calls. So that's exactly what we did. We sold a 7-strike covered call, which is a full dollar, over 10% lower than that original strike we had for the week. And we got a 42-cent premium on that one. So let's take a look at the math about where our basis is sitting after all this. So we know that the 8 minus the 32 gave us a 768 basis. And normally this would take 40 cents more off of our basis, but we closed it for 8, so it's only going to take 32 cents more off of our basis. So we'll subtract 32 cents more. And that gets us down to 736. So you may say, okay, well, normally we always want to sell covered calls above our cost basis, don't we? Wouldn't that be a 7.5 covered call that we would sell? And you'd be correct, but if you think about it, when we take away 42 cents here from our basis, we'll subtract this really quickly. What we end with is a 694 basis. So that 7-strike call is actually above our basis if they get called away. And since Tilray had already dropped so steeply from 842 down to 6.9 in less than a week on us, that's an 18% drop. This is really a play where we're just trying to get out alive. Now, obviously, most of the time when you sell cash secured puts, there's an over 50% chance you're going to hit max profit. So you're not going to have to deal with all this. But the important thing is to know what to do when things like this go wrong. So this is a good example about how this reduces our basis. And we know that this is going to be entirely evaporated because we held these to the end of the week. And by the end of the week, Tilray made it just back up above 7, I think roughly about $7.20. But we can't call this 7.2 anymore because we know our shares got called away at $7. So all in all, what we had was a $10,000 loss on the stock. So if we were someone who just was purchasing stock, didn't know anything about options, didn't know anything about the HT wheel and how to manage these positions, we would have incurred a loss from 842, which is even bigger, it'd be 842. We would have incurred a $14,200 loss. But since we got it at 8, it's only a $10,000 loss on the stock. We were assigned the shares at 8, they got called away at 7. But in the meantime, we got $3,200 here, $3,200 here, and ultimately $4,200 here, because you've got to remember you keep the premium no matter what happens with this stock. So despite the fact that our stock went down 15% on us in just over a week, and we lost $10,000 on the shares, the amount of premium that we were able to rack up actually left us with a profit of $600. And since those shares were called away from us on August the 14th, that means that it was a 1.28 week long play. And since we had a 0.75% return on capital, that annualizes actually to a 35.28% return, which is absolutely phenomenal when we have a stock that moves 15% against us roughly in just over a week. Another important thing to keep in mind is how incredibly these annualized return numbers can just build on top of each other. You might kind of turn your nose up at a 0.75% return in just over a week, but the fact that a 35.28% return annualized can result from a play where the stock dropped 15% is phenomenal. You always have to keep in mind that the average return year over year for the S&P 500 is just 9 or 10%. So anything above that means we're beating the market and means that we're putting winning strategies into play. And once again, had we not messed with options at all here, we've got a huge loss on our hands, that $10,000 loss or greater, since we would have been assigned the shares at 842. We'd have been sitting on a 15% loss. And instead, we've taken the power of options. We've leveraged the wheel strategy that we've laid out here and turned a 15% loss into a 35% annualized gain. And that is the power of the wheel. So as you probably can figure out, this was a pretty basic overview of what could happen. Obviously, a lot could go worse. There are a few intricacies that we mentioned earlier that we want to talk about. We threw together a diagram detailing the HT wheel strategy, and what we saw in this first video covered this part and this part. And while that may look like most of it, we're actually zoomed in on the diagram, and there are a lot more nuances we need to cover in order to help you most effectively manage your positions and generate the best returns possible in the market. Again, if you're familiar with the wheel, then this video is probably a refresher for you. It's not until the next part of this video series that we'll dive into the intricacies that make the HT wheel what it is. But for now, that's all we've got. Be sure to stay posted for the next parts of this video series and give us a follow on our social media accounts. We've got a great community of like-minded investors in our Discord chat, which will always remain free to join. So check out the link in the bio and come hang out with us in there. Until next time, this has been the Hourglass Trader, where as time passes, we make money.